Today, folks, dare I say, we're going to be reviewing a recession-proof stock portfolio, a crash-resistant and all-weather fund to protect you from this hyperinflated market and this expectation of interest rates going up this quarter, which I would suspect causes volatility of the S&P 500, especially those large-cap tech companies that a lot of people, as of the likes of Ray Dalio, have been thinking are highly overvalued. So that's the portfolio we're reviewing today. Ray Dalio, a multi-billion-dollar investor, very famous over the years. I highly recommend, if you don't know that guy, go watch some videos on him. And if this is something that interests you, of course, consider hitting that like button, because you might figure out some of these are in your portfolio already. But let's just dive into this, because luckily his portfolio here, Ray Dalio's stock portfolio, which is called Bridgewater Associate Holdings, and they got a little heat map here, which I really, really like. So let's just take a broader view of this, and then we're going to break them down one by one. So we've got three major global index funds making up the vast majority of this portfolio, with VWO, EEM, and IEMG. These are the ones we're going to start with, because it's kind of intriguing to see that the SPY, which has been performing so well, is the smallest percentage of his index funds. And we're going to actually look at how this entire portfolio holds up against the S&P 500 or the SPDR index, just to get a baseline to see how he's been performing against the U.S. markets, right, which is what everyone's kind of comparing themselves to these days. But take a look at this, because I honestly think he's almost under diversified buying these index funds, because when we take a look at the first one here, Vanguard Emerging Market Stock Index Fund, guys, look at the top 10 holdings here. We got Taiwan Semiconductors, Tencent, Alibaba, some companies I've never heard of, Reliance Industrial, Infosys, if I'm saying that correctly, Housing Development Finance Corp, China Construction Bank Corp, JD.com, like primarily highly exposed to China, right? Look at EEM, which is iShares MSCI Emerging Market Fund. And again, these haven't really done much, by the way, for literally the last decade. I know it doesn't help that China's selling off more recently, but I mean, the performance of these seems to be more of a place to park capital for protection rather than, I would think, upside growth for the time being. But yeah, take a look at EEM. Same kind of companies: Taiwan Semiconductor, Tencent, Samsung, Alibaba, Reliance Industrials, China Construction Bank, Housing Development Finance Corp, like literally the exact same companies, which makes me think it's going to be the same with iShares Core MSCI Emerging Market ETF. If we take a look at this guy, same sort of deal, guys. 10-year performance, 26% return, like really not much going on that front of it. And no surprise, Taiwan Semiconductor, Tencent, Samsung, Alibaba, literally all of the exact same companies here, folks. So it's just like, you know, when we take a look at the weightings on these, I mean, you're taking a look at these top 10 holdings, probably making up not much more than about 15% of the entire portfolio. So it is fairly diversified over the S&P that's largely concentrated in the top 10 holdings being tech. But at the same time, guys, like, I'm just kind of shocked you know, that he's holding three of basically the exact same funds. And I'm wondering if he's just doing that to diversify management, to protect himself maybe against these fund managers and the holdings that manage all of, I don't know what the deal is, but I just feel like that's highly concentrated. And we all know what's in the SPDR, right? So moving on from that, let's talk about these kind of consumer discretion stocks that we talk about, because I've mentioned largely in the past that companies tend to perform well in a U.S. market crashes. Obviously, global indexes, so we can see why Ray Dalio is like, forget the U.S., let's get out of here, things are overvalued. But in the U.S., the things that he is going to focus on are those primary recession-proof stocks that always perform well, which comes back to industrials, financials. Well, financials not usually as much, but in an interest-raising market, that's when financials do well. But we're talking about primarily, obviously, healthcare, and again, the primary consumer discretionaries being Walmart, Procter & Gamble, Coca-Cola, Pepsi, and then funny enough, Alibaba. But first and foremost, let's just talk about these top three, because they're the biggest: Walmart, Procter & Gamble, and Alibaba. Three companies that are very different and distinct in their own primary ways. So first of all, let's talk about Walmart. Walmart is a company that I've never been able to wrap my head around. It trades for like almost over double the value of something of the likes of Facebook, for crying out loud, with a PE of 50, has had no performance for over the last year in stock return. I mean, just take a look at the 1 year here, guys. Absolutely no return outside of the small dividend that it does pay. And when we just take a look at the year-over-year revenue growth, guys, from 500 billion to expected to do 571 billion, gross profits from 126 billion to 143. When we take a look at this chart for the quarterly, it looks like it's been kind of flatlining, or dare I say declining, on an annual basis. The last big bump they've had was in 2021 when people were overloading on products. So I'm don't understand how Walmart trades for a higher valuation than Facebook does. I've never been able to wrap my head around it. I'm kind of a bear on Walmart. I just don't get it. If you guys get it, tell me what I'm missing here, because like I get that they have a great, fundamental basis from assets, liabilities. I mean, the company's sitting on almost $100 billion in underlying assets, all that jazz. Wonderful stuff for a company that trades for $400 billion, but still, guys, like why is it so expensive? What about Procter & Gamble? Procter & Gamble's one that I have sorely regret selling. I actually held this when it was paying a 3% dividend yield. I can't even remember what I flipped it for. My ignorance led me to stray away from one of the best stocks I think you could possibly buy in the consumer discretionary space, and arguably probably one of the most recession-proof companies, because Procter & Gamble is famous for making everything that your toilet papers, your toothpaste. They just supply those consumer products that are largely used on a daily basis that we overlook. And you take a look, starting yield's not that great anymore. PE ratio is exuberantly high, in my opinion, but the company is proving still growth. They're doing very well with gross profit from $32 billion to $38 billion. But again, it's not like a fast grower here. I don't know if it deserves that kind of a high PE, but for some reason, the consumer discretionaries are just allowed to trade that high, and we just all accept it. But where there is one company that makes a lot of sense, and it's no surprise that these hardcore value investors like your Charlie Mungers are also leaning into Alibaba extremely heavily, along with the Chinese sector, right? Because, I mean, when you take a look at Alibaba, it really reminisces to me everything that you want to be buying in a stock. You want the stock chart going down, yet the stock price going up. You kind of see this inflection. It's an X. The X charts are my favorite charts. What do I mean by this? Well, if you take this chart that's going down and you cross it next to Alibaba's actual earnings and income, guys, it's an exact like replication on the opposite end. Like they don't correlate at all. And that's usually where you find your best value, is in these X charts, where revenue and EPS goes up, but the stock chart's tanking and you get a wonderful X crossing the line. And when you take a look at this, guys, I mean, again, Alibaba, we don't have to beat our heads against the wall about it. I just, it's one of those companies, man, where I was just watching Everything Money talk about Alibaba going down, and why when Alibaba goes down, you can feel comfortable buying more of it, because it's just the same story, different day, and the valuations continue to go up. Whereas if you're buying something more speculative, anything more speculative in your small cap growth areas where you don't have earnings or real revenues yet, or EPS numbers, that you have a harder time stomaching buying the drops, because there's nothing saying or giving reason to why the stock should rebound. The only thing that gives stocks reason to rebound is this right here, right? So for as long as this keeps doing this, it should inevitably be, presuming the political rhetoric around this company slows down, that it should come back, right? So taking a look here, let's take a look at some of the other ones. Now, we all get these guys. McDonald's is great. Starbucks is great. I think McDonald's next big front is going to be AI and robotics. Costco is actually a better buy, in my opinion, than something like a Walmart, because Costco is actually being able to grow. But let's talk about maybe gold here, because you can actually buy this gold index, which is kind of funny. It's the Spider Gold Trust, which kind of just tracks the gold pricing a little bit more stably, I'm going to say, perhaps. But gold might have an intriguing year this year if we start seeing more volatility and interest rates going up. So it'll be fun to watch this, because a lot of the gold stocks sold off. A lot of the exploration companies sold off last year, which didn't make a lot of sense, because we haven't seen gold prices dip below like 1,800 consistently. So their margins are amazing. So I think if you're a gold bug, I'm not primarily a commodity guy, but I really think that if you're into gold, this could be a good opportunity to look for some of those individual gold plays. But putting that aside, guys, we can really tell how Ray Dalio's kind of built this out to be more foreign exposed, more into those kind of value plays and protection hedges against a highly overvalued market. We got some healthcare in here, just all these kind of basic companies that I recommend you should be holding some of these in your portfolio. But is this actually holding up against the S&P 500? If you've been holding on to this, what would have happened? Well, let's take a look, guys, because the blue line represents the S&P 500, which we could largely say is overextended, could see a big pullback. But here's the AllWeather Fund, which honestly, if you are managing billions and billions and billions of dollars, sometimes your biggest concern isn't outperforming the S&P 500 as much as it is about capital preservation. Because you have to remember, from the dot-com bubble to 2008, you didn't really make a dollar. Like, you've been waiting over a decade from the dot-com bubble to get a return if you were buying the S&P 500. So Ray Dalio's lived through through that. He's lived through these multitude of crashes. He understands that we've had 10 years of one of the greatest bull markets in history, and whether that continues in the next year or so is still debatable. I honestly think over the next 5-10 years, we're still going to have incredible returns out of the S&P 500. So I'm more bullish on it than clearly Ray Dalio is, but I'm also bullish on some of those foreign stocks, which if they do come back, could catch back up to the S&P 500's return. But at this point, folks, I want to pass the question off to you. I'm going to leave the link to Ray Dalio's portfolio because there's a lot more stocks in here that you can review, that you can just kind of dig through with the ones that you might find interesting, because obviously we got things like Kimberly-Clark, CVS Health in here. I mean, Wells Fargo, a lot of these individual financial holdings, Constellation Brands, some alcohol companies, Morgan Stanley, Yum Brands, like very fascinating companies that I think are prevalent for newer investors to pay more attention to and perhaps even add or start adding to their portfolio. So I want to pass that question off to you. Of these stocks, what ones interest you the most? How do you feel about Ray Dalio? Are you interested in more of these foreign global exposed ETFs? I'd love to hear about all that in that description below, because obviously this is going to be the next 2 quarters, I think, are where you're going to want to really be comparing these kind of portfolios against the S&P 500, because things are going to get wonky. Stay cool, stay awesome, and I look forward to catching you in the next one.